Hi everyone, today I'm going to be talking about Datadog or Datadog, one of my favourite companies that I'm not yet invested in. SaaS royalty, in my opinion, trades at a crazy premium because it's a crazy strong business. A September 2019 IPO, up nearly 5 times since then. A great example of what SaaS companies can do and the thesis for investing in them in terms of growth and revenue. Huge total addressable market, and I'm going to be trying to blitz through it in about 5 or 6 minutes. So Datadog is a software as a services company that basically provides software to provide observability tools for software and security IT teams to manage if the tech stack is working properly. This is particularly important for cloud-based tech stacks. As you can see, they have a wide range of offerings and products. Datadog really invests quite heavily in R&D, much more heavily than its competitors. So this is really nice to see a wide array of offerings. As you can see, they have a strong history of innovation, so they've just introduced the unified data platform at first, then infrastructure monitoring, and over time they've introduced a wide variety of new products and improved their old products. Again, fantastic optionality. Datadog spends more on R&D than any of its competitors, continually trying to increase that drive and increase its competitive advantage. Just really what I like to see. I love optionality in companies like this, and it's strong improving company. This company's been on a fantastic journey since 2018, really shows in the revenue and income. Revenue's roughly 5x'd in 3 years, which is just absolutely tremendous. Operating income's now positive, and 30 million is growing really well. This is a company that's really firing all cylinders and has tremendous management and is really working on its goals to increase. So it's now not far off $1 billion in annual recurring revenue. It's going to hit this very soon. Really excellent time to be part of this company. So what is normally concerned for me with SaaS type companies is customer concentration. Datadog does not have a problem like that. There's customer concentration is excellent. There's hardly any. It has really strong dollar-based net retention numbers, above 130%, which is what you like to see. This has led to a growth in customers spending over $100,000. Rapid growth, so it's now about 10% of all customers, and increasing the number of customers generally. So growth in the number of customers shows the strength of Datadog's offering. A large number of customers take on more than one product. I'm by no means an expert in Datadog's software stack and the tech stack, but what I do know is that the people who are experts are spending consistently more, and more experts are taking it on, which is fantastic and is what I want to see. Also, the company has really high switching costs. When you're using more than one product, or even just Datadog, which is an essential service for some businesses, the switching costs are really high, and this gives it a tremendous moat. In addition to the R&D knowledge lead that they have over the competitors, this gives the company a really strong moat, in my opinion, which is again another thing that I love to see in these type of businesses. So many of you all know about the Rule of 40, which is something that large software companies are increasingly measured against. Growth rate plus profit margin should exceed 40%. Often easy for new companies. Now, Datadog is not a completely new company. It's IPO'd in 2018, but it's been around for about 10 years. Beating the Rule of 40 in any year is doing a good job, but keeping it going is hard. Datadog, this is just a comparison of some other companies that are richly valued, so I'm going to get to that problem in a minute. The Datadog is very richly valued. It has excellent score in the Rule of 40, so I'm using the most recent quarterly revenue and operating income percentage. Datadog is the clear leader, incredible tailwinds, and it trades realistically at a relative discount to Snowflake and Cloudflare. So you can see some of the richly valued companies there that are really been flavors of the month or 6 months. DocuSign took a big hit recently, so that's why its price to sell is so low. But it's still a fantastic company in my opinion. So now its market cap's around 54 billion, which is about half Snowflake's, but it's growing at a better rate. Its 1 year return's about 70%, and that's probably why the price sales ratio has got a bit carried away. Now at 64. This is never a company that looks cheap, and in my humble opinion, I don't think this is an investable company at these valuations. But there are plenty of other companies that trade this highly. Cloudflare and Snowflake being examples that I don't think is high quality. So looking at the stock chart again, like I said, roughly five times up since IPO when it's $36. Don't pay any attention to that percentage up the past 5 years. I'm a bit confused by that. Excellent company to own. 55 billion market cap company. I wouldn't be buying in right now. I think $174 is a bit expensive. 60 times sales is a bit more than I'm willing to pay. But I'm happy to be wrong, and I think this will be a materially bigger company in 5 to 10 years. And I think me not owning it will be to my detriment. I'm just trying to avoid. I've got quite a few stocks that are this richly valued like this, and richly valued stocks are not doing so well at the minute. I think they're going to struggle with the QE and taper and interest rate rises. But if you're taking a purely long-term view, any buy-in is a good buy-in, in my opinion. I'm just not prepared to do that at the minute, but I do think this is an absolutely fantastic company, and I think you should have a close look at this and consider adding it to your watch list. Thanks. I appreciate if you like and subscribe.